Wealth Management, joining us from Brookfield, Wisconsin. I look at the Bloomberg terminal, and the top story all morning long has been about shares of Capital One, Amex, tumbling, along with some other banks that issue credit cards, following President Trump's announcement that he is calling on these companies to cap interest rates at 10% a year, which could threaten their profits, billions in profits for the industry. Let's bring in now Nathan Dean. Nathan is our senior policy analyst at Bloomberg Intelligence. And Nathan, one thing that we need to make clear, President Trump calling for this is not the same as him actually having the authority to do this. Is this something in which he has the authority to call for a cap on interest rates for credit card companies?
No, it's not. And that should be the first question that these investors look at is how would President Trump implement this? Because, look, he said that effective January 20th that there would be a one-year cap at 10%. But really, there's no way that he can implement this. There has been legislation from Senators Bernie Sanders, the independent, and obviously Josh Hawley, the Republican, to actually put in a cap for 5 years. But that legislation really hasn't gone anywhere. Now, the industry average is around 21% going down to 10%. Obviously, you're going to see a significant decline in what the interest would be to these banks. And obviously that we're starting to see what the potential of that would be in the stock market. But, you know, our note that we put out to clients this morning is said, look, we only see a 30% chance of this happening in 2026. The more likely scenario is that President Trump uses the regulators. Ironically, it would be one of the Consumer Financial Protection Bureau, the regulator that they've been moving to get rid of. But they would use the regulators in the bully pulpit to pressure these firms to actually lower interest rates on their own. But absent that, you know, these credit card company banks, they can continue to operate as is.
Let's say this policy actually did go into effect. In terms of timeline, how long would it take for some of these companies to actually cap their rates?
So it'd be fairly quickly. I mean, obviously, it wouldn't be so much an operational standpoint of capping the rate at 10%, but the question would be, what are you going to do with the credit risk that comes out of that? Because, you know, a lot of these reward programs, think of those, you know, those fancy lounges at JFK and at DCA and Reagan, you know, a lot of that is paid for by the fact that you have high quality credit and you have low quality credit consumers as part of this. And so one of the note that we put out in the morning, this morning showed that if you were to curtail this down to 10%, banks would be a little bit more choosy about who they are offering credit to. You would actually see a decline in terms of the number of users of credit cards, which ultimately could have a small impact on Visa and MasterCard and so forth. But a lot of those reward programs that people enjoy would likely dry up as well, which is not something that I think a lot of the American populace would want to see, especially during an election year.
Yeah, especially since they already paid the $895 annual fee and want to get something for it. Nathan, you mentioned that there has been legislation proposed to target these interest rate levels at these credit card issuers. Now that President Trump has made this something of a rallying cry, do you think that that legislation will have more of a chance of getting anywhere?
So, you know, normally I would say more so in 2027, less so in 2026. The reason being is in an election year. And look, what President Trump proposed, there are a lot of Democrats on Capitol Hill that actually would be in favor of this. You want to cap credit card interest rates at 10%? You could probably get a significant number of Democrats to say, yeah, we're on board. But the problem here for the president is that there's probably an unspoken Republican populace. And I'm specifically looking at the House Financial Services Committee and the Senate Banking Committee at the moment that have bank allies that are completely against this move. And so what I think will happen is that if President Trump says that we want to push this legislation, and if the folks on the Senate side say, look, we want to work on this legislation, the most step that you would have is have a hearing to talk about that legislation. So hearing plus debate plus negotiations plus an election year, that just isn't a timeline to get it done before November 2026. I think the real risk is if you see this in 2027, but by then, you know, this issue may be moot and off the president's mindset.
Nathan, I'm just looking at the market reaction here from some of these credit card issuers. Capital One, American Express, just their share prices falling more substantially than some of the banks like JP Morgan. How much more significant would the impact be on these credit card issuers versus, say, the big banks that are also issuing credit cards?
Well, it's a story of diversification in revenue. I mean, the Capital One, the American Express, you know, the credit card issuers, you know, it certainly drives higher bulk of their revenue than if think of like the JP Morgans and Bank of Americas, which have investment banking, commercial banking, and other types of operations. And that's part of the reason why policy risk is hitting these companies more so than others is because, you know, if you look at Capital One and American Express in particular, you know, there's less of a deregulatory story to tell than what you're seeing in the big banks at the moment. You know, when they say that deregulation deregulation for the banking industry is coming, they're most likely saying deregulation is coming for those big banks in terms of capital requirements and returning towards those banks. You know, Capital One and American Express have a different type of operating model, and as a result, this issue in particular is more exposed. But I would just say is that risk for these companies continue because it's a Republican issue, it's a Democratic issue, and as a result, this bipartisan issue is going to continue in the headlines.
Nathan, before we let you go, just very quickly here, Senator Tom Tillis pushing back against this idea of the president targeting Jay Powell and the Federal Reserve. He says he will oppose any of Trump's Fed nominees, including the chair, until this issue is resolved with regards to the criminal indictment that's been threatened against the Fed. You think that will have an impact on the president, on the White House?
It will if Senator Thomas falls through with it, and it will depending on what his definition of resolved is, because the Senate Banking Committee is 13-11, and he can effectively jam that nomination up.
All right, good stuff. Always appreciate your joining us, giving us your analysis. Nathan Dean, Senior Policy Analyst for Bloomberg Intelligence, joining us from Washington, D.C.